Kia ora, and welcome to the CoreLogic Property Market Update for November 2020. Wow, haven't things heated up in the last month? Not just in the actual property market, but all the discussion around the market too. The Reserve Bank have been at the forefront of this due to the impact of their purposefully stimulatory policies. But before we delve into all that, let's first recap the market data. Firstly, sales volumes, and once again, last month was all go. Following on from an exceptional September, October lifted the bar again with over 10,000 residential sales when you add private sales to the almost 9,000 agent sales reported by Ryan's. This is only the fifth time in the last 13 years we've seen more than 10,000 sales in a month, so it's pretty significant. And all while we remain in uncertain economic times, with our borders effectively shut and in an environment of ultra low listings levels. So while new listings coming to market have been decent enough, they just can't keep up with sales turnover, meaning we're unlikely to see a material lift in advertised supply anytime soon. It's also worth noting that new listings tend to peak in early November as potential vendors steer clear of listing over the Christmas period, instead holding out until the new year. So it would be unusual to see new listings continue to grow this month. Of course, there's nothing usual about this year, so I'm not counting it out. For now though, a persistent lack of stock is contributing to rising property values. According to the CoreLogic House Price Index, nationwide values increased 1.3% in October, after effectively tracking sideways since COVID hit our shores. In Dunedin, 1.3% monthly growth replaced previously diminishing values, while Auckland is also back on the up with 1.4% growth over the month of October. The Wellington market exceeds both though, with 1.7% growth over the same period. Consistent demand from first home buyers and investors alike means competition for what little stock there is pushing up prices as urgency sets in. This is true on a nationwide basis as well as around Wellington. Though it's worth noting the minor dip in first home buyer share of activity in October as investors strengthened their presence, assisted by the previous removal of the loan to value ratio restrictions. This is clearly evident in the Reserve Bank lending stats, where the number of high LVR loans to investors, greater than 70%, in the last 3 months has more than tripled compared to the same 3 months last year. The corresponding figure for first home buyers, greater than 80% LVR, is a mere 25% increase. So when it comes to the LVR limits, we know the banks haven't strayed too far from the original 80% guideline, meaning the reintroduction of that limit, particularly for owner occupiers, is unlikely to have too much of an impact on the market. The stricter 70% requirement for investors, however, will take a section of buyers out, though the concern is whether foreshadowing their introduction encourages investors to get in while they still can, thus inflating demand and pushing prices up further in the short term. Whether that triggers the Reserve Bank into an earlier surprise reintroduction is a whole other question then. The Reserve Bank Governor has been at pains to express their mandate does not cover the housing market directly. However, the financial instability it may cause does. So it's down to whether such a significant increase in what has previously been defined as higher risk lending is enough to force their hand. I think it might, although the retail banks, led by ASB, have said they're going to self-impose the 70% restriction on investors anyway, so perhaps the need will be reduced. Of course, one other key factor when it comes to lending is interest rates, and all the latest developments only point to them continuing to drop. The official cash rate remains on hold at 0.25%, with a further drop in 2021 still more likely than not. The extra capital requirements, which would have brought upwards pressure on interest rates, have been further delayed, and a direct funding for lending program is all set to go in December. This program will see the Reserve Bank lend money direct to the banks at the official cash rate, with the expectation this flows through to the market and will bring yet more downward pressure on rates, to the point where sub 2% mortgage interest rates may well become the norm in the not too distant future. So then, that's all sounding very one way, but we do need to consider the headwinds on the horizon. The interesting thing is that even these are dying down, off the back of the latest unemployment figures for Q3 being relatively tempered at 5.3%. Forecasts are now being noticeably scaled down. In the latest Reserve Bank monetary policy statement, the forecast peak is now 6.4%, down from a forecast 8.1% in August. Expectations are that this lift in unemployment will flow through to renters more so than owner-occupiers, due to their higher rate of employment in vulnerable industries, such as accommodation and food services, retail, and arts and recreation services. so landlords may need to plan for tenant vacancies or downward pressure on rents. The other milestone we've been wary of is what happens to the market as the mortgage deferral scheme comes to an end in March 2021. But the amount of lending supported by the scheme has already dropped by a fifth, with the majority of that coming off in October. And there appears to be no visible signs of stress being experienced by those borrowers. A total of $4 billion remains deferred, which isn't insignificant, but it is a far cry from the greater than $22 billion back in May. The overall outlook then appears overwhelmingly positive for homeowners. There are a reducing amount of these though, so pressure will remain on policymakers if values continue to grow as we expect. Recent community virus scares also keep us on our toes with what might be next. So make sure you've got your finger on the pulse by subscribing to our weekly property market podcast and keeping abreast of all our content at CoreLogic.co.nz. The latest and greatest being a revealing report on first home buyers and just how they're remaining active players in the market. Mā te wā.